So the third way that we can break down where stocks, mutual funds, these different things can kind of hang out or be evaluated or separated from an overall diversification perspective. We talked about growth and income, or style that is. We talked about the size, as large, mid, or small cap. Taking both of those into consideration, now you can break it down by sector. And what we really mean by sector is what part of the economy does this company belong to? What area do they play on? What is their primary business? Think of it, like this is the industry they're in. This is what we do. We're a retail sector, or we're in healthcare, or we're in financial, or we're in energy, we're in entertainment, whatever it might be. Think about, well, this is what they do. And it's important to compare companies inside their own sector and within their subsectors as well. Because if you compare, let's say, an energy-based company that might be experiencing slower growth, or a utility, for example, that might be government regulated, but you can still invest in, maybe get a dividend from. If you're comparing that to a high-flying technology growth stock, it's not going to be a fair comparison in either way. You might say, oh, that technology stock's terrible. They don't pay a dividend like the utility company does. And the other way, you might look at, say, boy, the utility company sure isn't growing as fast as that technology company. I want the capital appreciation or the stock price to go up faster and maybe take on more risk for that. So that's why when you break it down by sector, each sector might have or industry might have things that are, or do have things that are particular to that industry, and you want to compare companies within an industry. Because you could have a utility company, for example, that might be very risky, almost like a growth stock within its utility industry versus others. Same thing maybe a little bit in technology or other fields. So when you're looking at things like ratios or fundamental analysis or qualitative analysis, evaluating the teams and all that stuff, you want to look at it within their particular sector or industry, and that's what we mean by sector. And then within sectors, you can have subsectors within that. I mean, you might think like, oh, well, retail is retail stores, right? I go buy stuff. Well, you have clothing stores, you have hardware stores, you have soft goods, hard goods. There's different ways you can even split those up. Like if we look at, let's say, healthcare is a good example of that, because healthcare is a good growing, I don't know about growing market. Certainly demographics are good for that. I like healthcare for a variety of reasons. One is the demographics. People are getting older. New medicines are being developed all the time. So healthcare might be an interesting sector to look at, for example. For me it is, I know. So, but within that, it's like, what part of that sector you have? Pharmaceuticals, which is like companies like Merck or Pfizer, which make drugs. You have medical devices like Boston Scientific or Medtronic that make like heart stents and valves and different, actual devices that people put in their bodies to be healthier or to recover. And you have things like Amgen, which is a biotechnology stock, investing in biotechnology. And then you can keep going from there, from managed care and life insurance to hospitals to nursing homes, all these different ways that you can break out that healthcare sector. So within that sector, it's not fair to compare, let's say, Merck, who makes drugs, versus Medtronic, which makes medical devices. They're different industries with different things. They're still within healthcare, but they share some similarities around government regulation, demographics, people getting older, all that type of stuff. But their competitors and how they should be evaluated are different. So it's good to not only look at the sector, but then the subsector after that would be my strong recommendation when you're looking at sectors. So sometimes folks will buy, let's say, a sector fund, for example, or we're going to buy all the energy stocks or buy a certain portion of technology or retail stocks. So you can look at mutual funds or exchange trade funds can really, look at the sector level. So if you think about it, you could be a growth and income stock, for example, growth or income, and it could still be within the same sector of healthcare. So they would be evaluated differently. So be aware of that when you're looking at them. And sometimes within sectors, it's hard to evaluate companies because they might fit really well in a sector, and other times they might play in multiple sectors and it can get a little confusing. So if we look at, let's say, for example, like Coke and Pepsi, they do lots of different types of side businesses and things too. But when you think of Coke and Pepsi, they're the two primary big competitors in the beverage market, in the carbonated beverage market. That's their direct competitors versus, let's say, an alcohol distributor or somebody like that. Coke and Pepsi, you can really evaluate real closely together. Or if you have a new company coming up, like a Jones Soda or somebody who's small, you can kind of compare that way. So they fit within that beverage area very well. Versus, let's say, if you look at like Disney, how do you evaluate Disney? Now you might be thinking to yourself, well, Disney, they have the parks, right? I can go to Disneyland Paris or Tokyo or Disneyland in the United States and California or Orlando, Disney World. You go to a theme park, you ride the rides with your family, it's fun, that's Disney, right? Well, and other folks might think, Well, that's sort of Disney, but Disney's really all about movies, right? They own 3 big movie franchises. They own, recently not too long ago, bought Star Wars from Lucasfilm, so they own the Star Wars franchise. They own Pixar, the folks who made Toy Story and those types of things, Frozen, all those types of animated movies. So they own Pixar, and they also own Marvel. So if you like Iron Man and the Marvel type comic superhero movies, well, that's Marvel is owned by Disney. So you'd be like, oh, well, they're a movie company, like Warner Brothers or MGM or somebody like that. They're a movie company. And they are, but then they do theme parks, and there's some relation between them, but the business for theme parks is probably really different than the business of movies, and they own these multiple parts. So how do you evaluate Disney, and what are you truly investing in? You're investing in the overall company, but understand those different parts of the company might make a difference. Maybe the theme parks are going great, but something has happened in the economy or in technology, like streaming of movies and things of that nature, of people staying at home more, watching movies on bigger, wider screen TVs from a technology standpoint. So that might hurt, let's say, the movie business in the future, but maybe their theme park business does great. Or maybe vice versa, something happens with the theme park business, and Universal Studios opens up more places, and a direct competitor of the theme parks for their theme park business. So all those things you would take into consideration with that. So even within sectors, it's kind of hard to evaluate within there. And then companies tend to move in concert within their sector. Not always, some outperform, some underperform, of course. But if you have an entire sector or an industry that's suffering, they're all going to kind of suffer together. They'll all kind of pull each other a little bit down versus one that might be rising. Rising tide lifts all boats. So a lot of times you might see where, things might follow along. It's not exact, but just understand that sector can impact even good performers. If a poor performing sector could impact a good performer within the sector unnecessarily, which might be a good value opportunity for the long term, by the way. So if we look at, let's say, something like the Vanguard Energy Index, which looks at energy companies, you might see how that index compares to the wider S&P 500 largest companies of all different types of sectors. Might be a little variance, but if you're Exxon, an energy company, and you're part of that energy index, you're going to tend to move in concert with the index, and maybe not as much in concert with the overall S&P 500 fund, but even still, all those things go together, especially now that we're in a more global economy. Things will tend to kind of go together a little bit more than maybe in the past, where you could have one sector just do tremendous and another sector be bad, and the overall economy is bad, but somebody's standing out. You always have maybe some of that, but it's harder because everything's so intertwined now. So things to look at. So when you're thinking about your diversification and when you're looking at your overall stock portfolio, keep that in mind too. Maybe you've been buying dividend stocks and you like income from it, but you might look and say, oh my gosh, all my dividend stocks are pharmaceutical companies. Johnson & Johnson, Merck, Pfizer, all these different big pharmaceutical companies, and I'm missing out on small and mid cap. I don't have anything in other sectors, and maybe I'm at risk around things like regulation around pharmaceuticals that brings everybody down. And then I'm like, oh, I'm exposed myself to more risk because I'm only in that one sector. So when you're looking at your overall portfolio, these are 3 big areas to look at. Look at the size, small, medium, large cap, the style, growth, income, maybe it's a value opportunity, and then the sector and the subsector, and understand where you can push to one side is great to get a bigger return, but you want to understand the overall impact of the different diversification, the different things that you own.